Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. Penultimate day of the year, 2025. And it's kind of quiet, except maybe if you're looking at gold and silver, where there has been a bit of a round trip in that sense. We're coming to you from the CNBC-TV18 Motilal Oswal studios. I'm Prashant Surbi and Mangalam with me. Guys, good morning.
Good morning. Welcome back, Prashant.
Welcome back, Prashant.
While that is. I think the markets weren't doing anything because they were missing your presence.
I just saw prices are exactly where they were when I logged out a week ago.
It's not nothing.
So someone said maybe you should have taken a longer break.
you called it
No, we missed you. We missed you.
You called it the penultimate day of 2025. From an FNO trading standpoint, it is the last day of 2025 because today is also the expiry. And I was looking at data from the day the Nifty started the December series. The Nifty was what? 25,860 thereabouts. Where are we? 25,940. So all of 80 points in all of December. So, even if you logged out at the start of the December series, the market wouldn't have been.
Guess who's not logged out? Those FPIs.
Yeah.
It's kind of shocking that even in the last one or two trading sessions of the year, where you'd expect all desks to be shut, they still managed to sell in the cash market. Some 2,000 crores plus selling happening.
The gross volumes are 60% lower. So 60% of them have logged out. The 40% are doing
that's stats. At the end of the day, there's over 2,000 crores that's gone out. But anyway, we hope that the next year is going to be better. 2 more sessions to go. So let's see.
I discovered a new word. Today is the penultimate day.
Yeah.
So there's a word for yesterday. How would you describe 2 days before?
Penultimate?
Anti-penultimate. Ante. A-N-T-E.
Ante-penultimate.
Last but two, basically. Third last in that sense. So anyway, let's just quickly kick off with, just the global market action, which is still on. And maybe last night, a little bit more in terms of price action as compared to what we've had. Silver and gold essentially really, center stage. U.S. equities lower, and of course, gold and silver prices took a bit of a knock as well. And, not very large. S&P down a little bit, 0.4%. The NASDAQ down about 0.5 actually. So those are changes. But the real story, of course, and the chatter is all about what's happening with precious metals. So a big correction. So yesterday, silver futures opened about 4% higher. They made a high of about almost 83 and then sold off 15% from that point. Gold prices, similarly from the highs, turned around about 5%. People are scratching and looking for reasons. There are lots of social media posts talking about how a large, systematically important bank has taken a large hit, etc., but no confirmations to any of that. What there is confirmation about, of course, is the fact that and this is not new, CME has announced higher margin requirements from the new year, starting the 1st of January. So is this an unwind in what has been a ferocious rally over the last 1 year? Silver itself is up some, 150, 160 odd percent. It's just maybe just to pull very large gains sometimes get you very large corrections along the way as well. Oil prices 2% higher. Here there is some news. There is, of course, the US-Venezuela tensions, which continue. But on the other hand, you also have Russian President Putin, who said that Russia would revise its negotiating position after an alleged drone attack on one of his residences, Putin's residences. It basically pushes out this hope, and that hope was there 2 weeks back, that perhaps some kind of a deal is imminent, peace deal, a ceasefire, etc. is imminent. You also have Ukrainian President Zelensky asking Trump for a 50-year U.S. security guarantee. U.S. has so far, of course, offered a 15-year security guarantee against further Russian aggression. Later today, you have the FOMC minutes, you've got the ADP weekly employment data, some house price data, etc., which I think markets will watch. Here in India, it has been confusing, as I said. I logged out a week ago. Prices have not changed. Base metals and their equity derivatives have done well. Things like copper, silver, gold, and consequently names on the equity side like Hindustan Copper, etc., have been big movers over the last 5-6 odd trading sessions, except that not very much. Yesterday, the Nifty closed below the 20-day moving average, which is a bit of a short-term reversal level. So, I mean, you know, but it's also true that it's a bit confusing. You look at a lot of charts, stock-wise charts, and in many cases, there are signals that stocks are bottoming out and reversing, whereas, of course, the Nifty is doing its own thing. So, maybe, you know, in the new year, once everybody's back and, I mean, volumes start to pick up, etc., you get a better sense, because otherwise, I mean, not really very much. On the Nifty Bank as well, we are very close now to the final support, which is the 40-day exponential moving average, which is 58,735. So those are levels for the Nifty Bank. So for the Nifty, yesterday's low 25,920 is important. And then, of course, the recent low about 5 days back was 25,700. For the Nifty Bank, the 40-day is the support, which is 58,735, which is getting closer and closer. So not a great setup, at least as far as the frontline indices are concerned, but at the same time, not very sort of conclusive sense that, you know, the market is breaking down or anything as we close this year out. So that's the picture. Mangalam, what's on your radar?
Yep, not pretty conclusive in terms of a direction, and that's exactly what you know, the FNOQs are stacked up as well. If you look at the Nifty Bank, the mid-cap index yesterday, yes, they were mildly lower, but were they, you know, breaking down? Perhaps not. And the other part is that as we move towards the end of the year, you know, on lower volumes, the impact is a lot more. So the same dollar sell, because of the lack of liquidity, would result in a bigger price move. And that's something that we saw in the broader markets as well. So advanced decline for the last 4 or 5 trading sessions have been firmly in favor of declines. Over 2,000 stocks in the red yesterday as well. And what did well on Friday undid its gains yesterday. So, you know, we had the metal stocks do extremely well on Friday. Well, that came under some pressure yesterday. All the railway stocks did well earlier, and now that came under pressure yesterday as well. All in all, if you just look at numbers, the Nifty and the Nifty Bank are stuck in this very narrow range. The Nifty broke below the 20-day moving average yesterday, which is just shy of 26,000, but is above the 50-day moving average. So if you look at both these averages, they themselves have a difference of, 70 points between the two of them. And the market is bang in the middle of that for the frontline index. Even the Nifty Bank, you know, it's a 500-point range, a mere 500-point range on 58,000, 59,000 sort of index, the 50-day and the 20-day moving average. And the December series expiry today. All of December series, despite the move that the markets made on either side, it's moved 0.002%. So that's the kind of move that we've seen in December series. The FIIs, they continue to sell in index futures. Let's see where that goes, because we've been waiting for some short covering to come by. For that, the market has to cross important levels. The only thing that may stand today is yesterday those put writers, you know, got it on the wrong side. So 26,000 put and the 26,050 put. All of them were caught on the wrong side, so they had to cover their positions. And today, there is writing at the 26,000 call and the 25,950 call. Will the call writers get stopped out today or not is the big question. And that may be the case towards the latter half of trade, largely because the put-call ratio is sub 0.7, which is indicating, you know, slightly oversold calls in the market. So yesterday, the put writers got it wrong. Today, maybe the call writers may get it wrong. Just watching out for 2 stocks, Hind Zinc and Muthoot Finance. Because of the decline that we've seen in precious metals, Hind Zinc has been on this record rally, and Muthoot Finance as well, as a beneficiary of higher gold prices. So will we see some profit booking on these names as well? Is something I'll watch out for.
Okay, absolutely. Let's keep them on the radar. By the way, precious metals, from the lows of yesterday, between the high and the low, the swing was 15% yesterday. And from that low of about $70, there is once again buying in Asian trade this morning. A bit of a climb back is happening. Silver is already back at about 73 last I checked, almost going towards the 74 handle. So yeah, let's see how that plays out. Asian markets, for what it's worth, you're not getting any clear cues there. Listless, directionless. There's a little bit of red, a little bit of green. By the way, SoftBank is hitting headlines in Japan this morning. They are investing $4 billion in another data center company. So yeah, AI continues to be top of mind even as this year dies down. Let's pull up the GIFT Nifty and the implied open. It's suggesting that we'll probably have a cautious start. The bulls couldn't hold on to 26,000 yesterday. And well, at the start at least, they may struggle. Now, the question is whether the buyers will come in or whether the buyers have gone on New Year break. And I think we'll have our answers over the next couple of hours. Well, with that, let's introduce our first guest on the show. We have Taimur Baig, Managing Director and Chief Economist at DBS Group, joining in. Taimur, thank you so much. Season's greetings.
Season's
I am
greetings,
so glad.
Ravi.
I'm sorry we're making you work and you're here with us in the studio, but thank you so much for doing that. Because, we're coming to the end of a very interesting year here in India. Yesterday, Finance Ministry officials released, some macro stats on India. What caught my eye was the title. They said it's a Goldilocks phase for the Indian economy. And then they, of course, gave a lot of the reasons why they think so. Markets here have not quite felt like Goldilocks in India. Do you think that's going to change in 26 for the better?
Sometimes taking a longer view is useful. When I talk to VCs in India or PE managers in India, they tell me that the boom of 22, 23, 24 have spilled over into healthy capital market dynamics in 25. So even if the headline numbers that we talk about on the media suggest that the stock market had a listless 2025, when we talk about the providers of capital and the borrowers of capital, it's been actually a stronger year in terms of per deal revenue. So that tells me that instead of just looking at the fact that this was not a great year for Nifty, we should think about the fact that the 22 to 24 boom paved the way for a very strong capital market dynamic in 2025, which might even provide foundation for strong earnings growth in 2026, when even if that Goldilocks sort of is behind us, the extremely low inflation, we should look at the half full part of the story, which is in 2026, we'll probably see a pickup in nominal GDP growth. As inflation normalizes, we're looking at a 10% nominal growth year in 2026 calendar year, as opposed to 2025, where we think about 9.2% nominal GDP growth.
Usually, people equate corporate earnings to nominal GDP growth because that's where, the profits come, which include inflation. In your analysis, what is the correlation out there? And do you believe that corporate earnings will be double-digit in FY27?
It varies by sector in a very big way. If we have a situation where nominal GDP growth rate picks up, along with that, there's some upshift in nominal interest rates, market-driven interest rate, not RBI-driven interest rates, then of course that has a sort of a complicated picture as far as non-financials are concerned. But banks, for example, see an improvement in NIMs, and they then make more money. At the same time, we can reverse the causality and say the higher nominal growth is actually a function of stronger demand as opposed to a policy-driven outcome. And therefore, even if rates are higher, borrowing takes place. I normally think of a situation where sentiment is strong. It doesn't really matter what the interest rates are. Borrowing takes place. If the sentiments are poor, no matter how low the rates are, people don't borrow. We're looking at 26 as a year where sentiment picks up on the borrowing side of the spectrum. Good for financials, good for lenders, but also underpinned by strong borrower confidence.
Taimur, I don't know if you agree with this. I'm just throwing this idea out. Globally, just look at what's happening, right? I mean, this is in terms of just radical innovation, this is perhaps right up there as one of the phases over the last couple of years. You look at all what is happening in AI, but forget just AI, but using AI, so much happening in drug discovery. I mean, we're talking about data centers in space now, right? I mean, unimaginable, right, over the last couple of years. And it's not as if 2025 has been a bad year. I mean, Korea has done extremely well. I mean, so many other markets have done phenomenally well. And here there seems to be a lack of enthusiasm. What will drive things from here? Will it just be waiting for that slight earnings recovery or what? What's your sense?
Well, Prashant, the obvious gorilla in the room is the uncertainty vis-a-vis the U.S. And if we start 2026 with some positive development in that area, that certainly helps. When you talk to sort of gems and jewelry exporters, it has not been a good year at all. It's been very, very challenging with the tariff backdrop. Similarly, with other exporters that have found U.S. to be a critical market, it's been a tough year. I think the big lesson for 2025 for me, again, trying to take the half-full view, is the criticality of non-U.S. markets. We cannot put all our eggs in the U.S. basket, which I think was probably the safe thing to do in the past because U.S. was a very reliable counterpart. I think we can safely say that is not going to be the case, regardless of whether there's a deal or not. And hence, Middle East, Europe, East Asia, in my view, very, very critical for Indian industrialists to look around, not just for exports, but also for deals. Again, going back to my earlier point that the boom of 23-24 have now allowed Indian capitalists to go shopping around the world. Despite the fact that the market has been lackluster, they traded strong multiples relative to the multiples in that part of the world. So therefore, you see when you go to Seoul, you go to Tokyo, a lot of Indian VCs, a lot of Indian industrialists showing up, looking for technology, looking for interesting buying opportunities. So it's a question of recognizing the non-criticality of the criticality of the non-US markets.
The happiest creatures in the capital market ecosystem clearly have been the investment bankers. I'm sure they're getting set for a really big New Year party. But, on that point of deals, I mean, not that it's directly related to your area of study, Taimur, but since you talk to so many people in the financial universe, we've seen deals and we've seen deals and we've seen M&A. I mean, the latest was Coforge going ahead and picking up a large, a global entity, a US-based company. So there's that. But then the big talking point has also been a lot of the exits. Foreign private equity exiting, foreign promoters exiting, foreign parent companies exiting, Castrol being the latest one now, selling a part of their business here. Does that tell us that, this is money that doesn't see that level of India growth ahead? The kind of India growth for which foreign capital would always pay top dollar. Is that a cause of concern?
Not at all.
Okay.
I think the exits are a very good sign because that tells you that if you do put patient capital in India, that patience is rewarded and you get decent returns. I know lots of people in the private equity industry. 5-6 years ago, their life was very challenging because rolling over funds was difficult because people were saying, where are the successful exits? Give me some examples. Yeah. Tomorrow, if you go out to raise fund, you can provide dozens and dozens of examples of successful exit. It is telling you that the capital market is deepening. There is sufficient local demand and there is sufficient new investors to take on the exits of the previous players. So I would see this as actually a positive sign. Now, we can argue that, well, it has come at a difficult time for India because that had actually made the rupee a little weak. Yeah. It's caused some complications in the capital flow environment. But to me, that is a very short-term temporary blip around an overall constructive picture. But I go back to Prashant's question about, what will drive the markets in 2026 for India? Is there an AI-type catalyst there? To me, that would have to be A, normalization with the US, but B, as I'm seeing when I travel in East Asia, that the Indian corporates are becoming more and more constructive vis-a-vis East Asia. You remember, there was a time when India was not really looking east anymore. Yeah. Everything was to the west. The alignment was with Europe and the US, and India's growth leverage was going to come from there. I think that recognition is the other key driver. Look at the performance of East Asian markets this year.
That's what I said. I mean, actually, exactly. Korea is the tiger this year, right?
Let's not forget China either. Yes.
China as well. This is the time for forecasts, Taimur. One non-consensus forecast from you.
I think it's not necessarily an economic growth or market turnover forecast. I think the increasing recognition of new tech coming from China.
But that happened in 25, right? I mean, I think...
So, on drug discovery, you had mentioned very briefly that issue. That to me, when I talk to Western drug CEOs, whether in Europe or the US, they are busy setting up joint venture with Chinese drug companies because on aging, on protein folding related matters.
Cancer.
Cancer. Gene therapy, the key breakthroughs are coming from Chinese labs. So the greater recognition that key breakthroughs in tech, not just in life science, but from a wide range of sectors, would come from China, sort of changes the game. In the past, the narrative has been the Chinese copy technology, they steal IP.
But I think that's
the workshop of the
got
world.
debunked in 2025.
You would be surprised to see the number of people I meet in the West who still believe in that stereotype. Yeah. The question is, how much are they willing to pay for new tech coming out of China?
My only hope is that, it almost feels like US and China are racing ahead and everybody else is
no one's looking at us.
Everybody else is falling into the gulf. I just hope we really kind of recognize some of this.
When you speak about innovation, when you speak about what's coming out of China, what's coming out of the US, the question that we're still asking is, when will capex pick up? When will consumption
That's what I was. That's what I meant. I said some of the all important, Mangalam. But
they're all important, but the different points.
So, Mangalam, the issue is, if the Chinese find it difficult increasingly to deal with the US, my view is that they will be better players in dealing with the likes of India. Yeah. I think the EV space is a very good example of that. They're okay with tech transfer. They're okay with 50-50 joint ownership. Increasingly around a wider range of tech stack, the size of Indian market will bring them to play with better terms.
Well,
that's a prediction to remember. Better India-China sort of alliance and maybe just a win-win for both.
On equal terms.
Well, fantastic having you with us here. Wishing you all the best. Happy New Year.
Happy New Year.
Team.
Take care.
And fantastic shirt, by the way.
Yeah, I thought that would come much earlier in the conversation. I'm glad that it's not a jacket and a tie.
I was not going to wear a jacket on the 30th of December, yes.
All right, well, let's just quickly run you through the interactions which are lined up here on the program over the next 2.5 hours. Parag Thakkar is going to be with us at 8:30 from Fort Capital. We'll talk about some fundamental stock ideas. 9 o'clock, Aditya Valekar of Access Securities with a look in into what's in store for the steel sector and more. 9:20, Nimesh Chandan and Bajaj Finserv AMC is a market master. 9:35, the management of Chola Finance joins in for a discussion on their outlook for H2, actually more FY27 rather than anything else. We'll get you a special discussion around rare earths at 9:45 a.m. That was one of the big hot topics in 2025. Will it show up in 26 as well? We'll discuss. And of course, we will be speaking with the management of HPCL on their FY27 outlook and more at 10:15. That's the lineup.
All right. With that, let's tell you a lot of stock-specific action, which we'll get to in just a bit in our special Top 10 segment. But we're looking at Reliance, Shriram Finance, Lupin, Entero Healthcare on our radar on the back of positive news flow. And on the other side, on the obverse side, we have Interglobe Aviation, Nazara Tech, Wari Energies, and Eternal, stocks that are likely to open in the red. Well, there are a bunch of stocks that we're watching out for on the back of news flow as well. Mixed news, but there's Bandhan Bank, there's ESAF Small Finance Bank, which are likely to open mixed.
Welcome back. Well, as we've been telling you, Qs are a little muted thanks to the handover from Wall Street, where we saw some declines in Asian markets this morning, not really racing away. The Hang Seng is the one that's a bit of an outlier with some green, but the implied open is telling us that in all probability, we'll have a cautious start. Let's pull it up. It was about 30 points lower. Yeah, still is 33 points lower. That's the implied open for the Nifty. Now, what about individual stocks? Some names on our radar today as well. So let's straight away get to our team with the CNBC-TV18 list of top stocks to watch. Guys, morning to all of you. Sonal, let's start with Reliance because the company issued a very clear statement on certain reports and allegations with respect to KG-D6. Tell us what exactly has happened.
Okay, so there was a Reuters report which alleged that there is a $30 billion claim which the government is asking from Reliance Industries and British Petroleum for some gas produced in KG-D6 basin. It indicated that because the gas wasn't produced as promised or as guided for, the government is charging them $30 billion. They have outright denied such reports and called it inappropriate and irresponsible. Now, the report suggested that Indian government was seeking more than $30 billion in compensation to basically ask, it was because of them failing to produce gas from offshore fields. Reliance Industries says the claim made by the government is around $247 million and it is not related to this particular gas production that Reuters is talking about. The $247 million order has been disclosed in its audited financial statements and everybody is aware. With respect to the production in KG-D6 basin, these issues are currently with the courts. There's nothing that has been finalized yet, and that's why they are denying any reports made by Reuters. So that stock will be on our radar today.
Indeed, that stock will be on our radar today. Sonal, thanks a lot for that. Let's go across to Sudarshan. Sudarshan, there's always news on Indigo, and what are you tracking today?
Good morning, Mangalam. So over the last few days, one thing has become very common, the advisory from airline companies and all the advisory that come in the morning. And that's related to that your flight might get delayed because of fog or smog due to pollution, especially in northern part of the country. But today, Indigo is in the focus for different reasons. It has hiked the pilot allowances and it's hiked across duty types, and it's hiked for domestic layover, deadhead allowance, night allowance and domestic transit allowance. That will lead to increase in the cost. Indigo is also facing another headwinds, if you can say. There has been a sharp depreciation rupee against dollar. That will also lead to increase in the cost or lead to increase in the forex loss. If you remember, in Q2 also there's a huge forex loss that company had reported almost 3,000 crore rupees. And even in Q3 we are expecting there can be a huge forex loss. And if you talk about the performance, on-time performance for Indigo has improved, but still it's much below the desired level. On December 28, that data we have on the Aviation Ministry website, it was 75%. That's the second lowest if you compare against all the airlines. But if you talk about the passenger load factor, it's slightly improving on it's improving on the regular basis. And on December 28, it was almost 90%. That's slightly below the desired level, but still much better than what we saw in the early part of December. But on the basis of, on the reason of company hiking the allowance for pilot, I'm going with red.
All right. So thanks very much for that. I mean, the price has been kind of flattish now after that bounce from the absolute lows. So about a fortnight now, price is around 55,000, 5,100, around between those two levels. Let's talk about financials now. Shriram Finance should be in focus. There is a ratings upgrade after that big deal. Bandhan Bank is also the other one we want to talk about. Gaurav is here with details. Gaurav, morning.
Well, yes, if you look at Shriram Finance, it was only last week when we saw a huge deal coming up, and now again CARE rating has upgraded the rating for Shriram Finance and its NCDs and subordinate debt. So technically we could say that the series of good news is actually still going for Shriram Finance, and the reason being that these NCDs and subordinate debts are worth 2,500 crores, and reason that they have cited is that they say that this is based on the recent developments including operational and financial performance that the company has shown. Now if you look at the impact, as per management, as we spoke earlier, they said that any credit rating upgrade can actually result into the cost of funds going down almost by 100 basis points. Remember, the cost of funds are anywhere between 8.7 to 8.8% for the company, which is still higher than its peers. So definitely it's a positive news for Shriram Finance. Apart from that, let's also focus on Bandhan Bank today, because company has now identified and approved to sell NPAs and written off portfolio worth 6,872 crores for a value of 901 crores to ARC. And at the same time, on the same lines, let's also focus on ESAP Small Finance Bank, because here also we saw board approval coming up for NPA portfolio sell of worth 1,693 crores for a value of 183 crores. So definitely watching out on these three financials in a day today.
Okay, all right. So all the three financial names will be on our radar. Gaurav, thank you very much for that. Let's get to Ekta. I think she's watching out for Lupin today. Ekta, morning. What's the news?
Morning. Well, very interesting news which is coming for Lupin, because they've signed an exclusive licensing agreement for a GLP-1 drug. It is with an agreement with a Chinese-based company, Gan and Lee Pharmaceuticals, for what is called a bonfanglutide, which is basically a GLP-1 drug. Lupin has exclusive rights for this drug in India to commercialize and distribute it. And the differentiator of this particular drug is that it is fortnightly. So basically you have to take an injection once in 2 weeks, as compared to the current injection regime, which is once a week, or the oral pills, which are every day. So this is going to be something which is less frequent in terms of dosing, and is expected to be expected to show the same results as the weight loss drugs that exist already. So this is a completely rapidly changing environment, and Lupin is going to be participating in the GLP-1 drug in a world by this exclusive licensing agreement. Interesting times, you'd have to say. I expect this stock to possibly be in the green.
All right, that's about Lupin. Interesting times for them. Also interesting times for Blinkit or Eternal. The reason why I say that is because our colleague Shilpa has picked up from her sources that the CFO, Vipin Kapuria, has resigned in just a year. He joined as the Blinkit CFO in October 2024. So it's less than a year as well. And Amit Sachdeva had quit in August 2022. And Blinkit and Eternal obviously have declined to comment on the same. But if this is true, then it is important because it comes on the back of 3 or 4 important news pieces coming in right now. One is, Albinder Dinsa saying that the quick commerce bubble is, it's a bubble, basically. Yeah. The second part is Swiggy has just raised funds, so they're obviously at par when it comes to money. And Zepto has filed for its, confidential DRHP papers for IPO as well. All of that when competition from other players is increasing, and Blinkit from a financial standpoint, from a CFO's business standpoint, the important change that they had made is they had gone into from third-party selling to owned inventory models. So their numbers also changed from just recognizing the take rate to recognizing the entire gross merchandise value as sales. So there were a couple of changes that happened from a reportage standpoint as well. So to that extent, a CFO continuing would have helped, but maybe see a mild bit of red on account of this news. Is the CFO of an important part of the business, but not the entire business.
Yeah, but that's the part of the business the market has its eye on. And that's the part where, the debate is whether they'll invest more and what happens to profitability, so on and so forth. But so let's see. Definitely worth keeping on our radar.
The only point is that the consumers won't stop ordering on Blinkit just because the CFO is resigned. Which is why I said mild red.
Okay. All right. Well, let's move on. Vivek has a couple of other names on his radar as well. Vivek, morning.
Well, good morning. Nazara Technology yesterday was a sharp mover, high volumes. SBI Mutual Fund sold close to 45 lakh shares at 240 rupees a share. Post the block deal or post the bulk deal, you did see a significant amount of recovery in the stock. Post the second stock on the radar is Entero Healthcare. Yesterday, ICICI Prudential Mutual Fund picked up a small chunk, almost 21.8 lakh shares at 950 rupees a share. And Waaree Energies, a little amount of uncertainty. The CEO, Amit Paitankar, has resigned with effect. He has a long notice period. He will stay on till May 2026. The company has gone ahead and approved the appointment of Mr. Jignesh Rathod, presently the Director of Operations, as the new CEO. And he will take over once the current designated CEO actually steps down. So, some uncertainty, but Waaree Energies will remain in focus on the back of the management change.
Okay, all right. So we'll keep those stocks on our radar as well. Vivek, thank you very much. So let's recap our list. The ones that have positive news flow around them and therefore may open positively would be Reliance, Shriram Finance, Lupin, Entero Healthcare. Quite a few names with negative news flow around them, and they include Interglobe Aviation, Nazara Tech, Waaree Energies, Eternal, Bandhan Bank, ESAF Small Finance Bank. There could be some sort of either a mixed or slight negative opening around these stocks, so let's watch for them. But speaking of all the headlines, actually they're coming beyond the equity space. They're coming entirely from what's happening in the precious metals arena. We have Manisha joining in. Manisha, 15% surge in one trading session. My God, I think you're almost giddy trying to follow the silver price action here. What's the latest?
Well, yes. What we saw on Friday did get turned around on Monday. So that is how you're looking at the holiday period, lower volumes and a lot of movements coming in, margins getting hit. CME also has come out with further margins looking at the volatility that we have in many of these commodities. So what we saw overnight was a big profit taking. If you look at the silver prices, they fell 9% overnight. So after gaining 10% on Friday, it is a 9% decline that you're looking at on Monday. This is a profit taking after an end-of-year rally that you have seen. But even with this, silver is on track with 156% of gains in 2025. It hasn't just been silver. You saw profit taking of 4% in gold as well. After hitting an all-time high of $45.50, we are trading at $43.50 right now. So $200 shaved off in matter of New York session yesterday. Investors have logged in profit, and the street is also looking at Russia-Ukraine peace deal progress. That also has led to some, sentiment easing coming into the markets there. And then you saw copper prices decline as well. We've seen copper gain up by 8% for the month of December. So some decline, almost $200 of a fall is what you saw in copper as well. And yes, platinum, that fell 12% overnight. It is still up 140% for this year. So while 2025 is going down as a very, very strong year for many of these precious metals and base metal prices, but overnight has been nothing short of very huge profit taking in yet again a very low volume scenario.
Manisha, silver is up how much this year? 150. 150%?
It's up 156% this year, yes.
156, okay.
Yes.
So this is perhaps the, should be the best one since what was it called, right? The famous silver move in the 1970s, right?
1979, that was Prashant. 1979, we saw silver prices gain up by almost 200%. So this is the best year since then. And yes, we saw all-time highs in 1998 and then 2011. And after this, this is the first time ever that we've seen $50 cross and $80 cross as well.
Hunt brother, I was looking at that Hunt brother silver squeeze. I think prices went up, I think more some 5 times basically in that 1 year, 79 as Manisha said. Manisha, thank you very much for that. Great to get that perspective and of course round about the action from last night as well. Take a quick break. We'll come back. Parag Thakkar of Fort Capital with us for some fundamental stock conversation. Stay tuned.
Welcome back. You're watching us here on Bazaar Morning Call, the penultimate trading session of 2025, and the GIFT Nifty indicates it will be a 38 point downtick at the open. Not too hot, not too cold. That's the range as far as December so far has been concerned. Let's get into individual stocks. Parag Thakkar, who's a senior fund manager at Fort Capital, joins us now. Parag, overnight we saw a big drop in commodities. You think that maybe the rally that we saw in commodities on the back of these underlying commodities rising may come undone, or this is just a small blip profit booking before we restart a rally?
Good morning, everyone, and Happy New Year to you and your viewers also. So I would like to say, see, I had Hindalco in our portfolios since long, but we have booked out profits, and now we don't own any commodity stock in the portfolio. And I would like to say that after such a big rise, like 156% increase in silver, and I would not be a buyer in these stocks. I would not like to comment on whether the rally will continue or not. The only thing is that if Russia-Ukraine settles down a bit, then I would say that there will be some correction in at least in precious metals. Of course, the quantitative easing again starting is supportive for this precious metals and all other metals. Plus, there is a physical shortage of, say, for example, aluminum structurally, or might be copper and silver also. But I would say that after such a big euphoria, I'm not a buyer. In fact, I would strongly urge government to look at selling some stake in Hindustan Zinc. They hold 29% stake, which is worth around 78,000 crores. So they should do a OFS, gradually sell some stake in Hindustan Zinc when the price is so good.
Hindustan Zinc, yeah. The other one, Parag, hi, morning. Good to see you. Hindustan, the copper is the other one, right? Precious metals is one, but in base metals, copper has had a clean breakout to all-time high. Again, for many, that is the favorite kind of play on everything, a bunch of things, which is, grid upgradation, etc., everything. Look at Hindustan Copper here, right? 50% in December. 50%, that's a huge one. I think it was at 320 at the end of last month, almost 490 as of yesterday's close. Any thoughts here?
So I would not be a buyer. As I said, Prashant, I would not be a buyer into this momentum. I am a contra buyer. I am buying FMCG, cement, Coforge, Reliance kind of things right now. I am not a buyer in this name because I don't want to buy after 50-60% move in a month.
Yeah, no, that's it's important to resist the temptation and not get sucked in also, because that is what typically...
There are too many FOMOs which you have to stay away from, right?
Temptations.
Like loss-making companies getting market cap of 1 lakh crore and more immediately on the listing day. Yeah. That is a kind of FOMO which you have to stay away from. At some point, this will fizzle out.
I think this is life advice Parag is giving, not just stock advice today. Stay away from FOMO, stay away from temptation. So speaking of that, Parag, what I found really interesting was your FMCG call. I don't think I've ever heard anyone in this year say that they really want to now start building positions in FMCG. So let's start right there.
Should we be saying that with Mangalam by your side?
I know. But it's been the hard truth, right, for many, many quarters in the market. And for good reason, because the market wants to reward and buy growth. And growth has been anemic, 2, 3, 4%. And no one likes to hear single digits in India. In India, you come and you buy growth. So what's your thesis here? What's changing?
Based on my channel check, after the November month, which Hindustan Lever has also said, things have picked up on the ground in FMCG. You will see results. I think my channel check suggests that Godrej Consumer, Emami, Marico, this kind of companies will report good numbers. And I think Q4...
What is good, Parag? Define good when you say good? In terms of volume growth, top line growth?
See, high single-digit volume growth will be a good number. And EBITDA growth of about 12-13% will be a good number in my view. Some of these companies have very low base also. For example, Godrej Consumer, Dabur kind of companies. Some of these companies have advantage of season also, like Emami has a winter advantage. Yeah. I would say that this is a sector, and cement also. For example, I'm hearing that in the month of December, cement demand has revived in East, and so companies might attempt to take a price hike from first. And January, February, March quarter is generally strong for cement in terms of demand. So I would like to say that cement and FMCG are good contra-wise at this point. apart from IT companies like Coforge, where again there are many discussions going around the valuation of the acquisition.
Interesting calls, Parag. We'll ask you to hold on to those thoughts. Cement, FMCG, and a couple of these mid-cap IT names. And I take your point entirely on companies like Dabur and Imami, which also stand to benefit from a low base and a longer winter season. And valuations as well for both of them, not as demanding as they are for other FMCG companies. What we'll do is get on to other calls of the day as well. They come in from the brokers who've written this morning. Sudarshan has gone through the entire list. Sudarshan, what are you picking up?
So first one, Avendus has returned home textile companies. It has initiated coverage on Indo Count with a buy call and target. It has given is of rupees 348, and it has initiated coverage on Welspun Living with a reduced call and target for that is 135 per share. And the reasoning it has given is macro developments such as tariff rationalization and progress of FTAs, that is free trade agreements, will be key monitorables going forward. It believes that Indian players or Indian companies are repositioning within value chain through diversification, branding, and the rapid expansion that these companies are undertaking. Falling US imports reflect demand moderation and inventory rationalization that will likely to impact both earnings and the volumes in the very near term. But as per Avendus, this is more cyclical in nature rather than structural. So it's largely positive on home textile companies. Second, another positive note coming in for Lenskart. If you go by the Bloomberg data, currently there are around 6 to 7 brokerages which have coverage on Lenskart, and of total 4 have a positive stance on the stock, and the highest target price from the street is 530 rupees per share. Today, MK has initiated coverage with a buy call, and it has given target of rupees 525 per share. It says company is a clear category leader in a structurally growing $9 billion eyewear market, and industry CAGR is currently at 13% with strong tailwinds coming from GST cuts and fashionalization that MK has given a new word. Best-in-class unit economics and scalable tech-led models support rapid expansion and margin compounding that company might see, and multiple optionalities and rupees 4,000 crore net cash provide long runway for growth as far as Lenskart is concerned.
All right. So thanks very much for that. More coming up on brokers and what they're saying a little later, but that's the list for now. We'll take a break. We are back. We will focus on some technical trading ideas on the other side. We also, of course, focus on the big movers from yesterday. Sudarshan, Mitesh on the other side. Stay with us. Welcome back. Hormuz is now with us with the big movers from yesterday, which saw heavy volume action. Hormuz, morning.
Good morning, Prashant. And defense names were, of course, in the spotlight all through yesterday. And Midhani was one such name with a double-digit return for the stock in Monday's trading session, which was the biggest single-day gain since May. The volumes yesterday were the highest on record for Midhani, with close to 4 crore shares being traded. The 20-day average is just under 4.5 lakh shares. So significantly high volumes there. And out of those 4 crore shares, though, only 26 lakh shares were marked for delivery. The 20-day average here is less than 2 lakh shares. The other interesting bit, though, is that yesterday's turnover of close to 1,400 crores was almost 75% of its free float market cap, which is close to around 17 to 1,800 crore rupees. And the stock, although it's down around 25% from its 52-week high levels, it's still up almost 4x from its IPO price, which was around 90 rupees. Now, Dixon, we'll talk about that in detail in just a bit, but yesterday's session was the 6th straight day of losses for Dixon. The stock ended at a 52-week low, has declined in 8 out of the last 9 trading sessions. Now, 13 lakh shares were traded yesterday, the 20-day average of 5 lakh shares. And out of those 13 lakh shares, 5 lakh shares were marked for delivery compared to a 20-day average of less than 2 lakh shares. It's had a disappointing year so far, down 33%. And HEG was one mover yesterday. Both HEG and Graphite did well in yesterday's session. HEG in particular ending almost 7% higher. The 4th straight day of gains is up almost 13% in the last 4 sessions. It's gained in 5 out of the last 6. Monday's volumes were the highest in nearly 2 months, with close to 1 crore shares being traded on HEG, 20-day average of 8 lakh shares. And out of those 1 crore shares, 15 lakh shares were marked for delivery compared to a 20-day average of less than 3 lakh shares. And the stock is also now nearing its 52-week high, which is 619 rupees.
All right, Hormuz, Dixon Tech, that's the stock in focus, as the stock is set for its worst year since 2018. In fact, stock is down 33% in this year itself. What's impacting the stock?
a lot of things. The near-term growth concerns surrounding Dixon, but you get to the price action first up because down around 38% now from its 52-week high levels of around close to 19,000 rupees, which was in January of this year. And from there on, it's been a slow grind downwards for Dixon. And this is only the third time that it is going to be delivering negative annual returns since its listing back in 2017. But in 2018, the stock was down 50%. And since then, if you see this year, the stock's down 34. Yes, last year, the stock had almost tripled in value. In 2023, the stock was up almost 70%. So it's turning out to be a disappointing year for Dixon. And just in the month of December itself, the stock is down almost 20%, and which is turning out to be the worst month that it has had since January of 2023. In fact, last year when the stock had more than or nearly tripled in value, it had gained in 11 out of the last 12 months. And now if you take a look at what this is turning out to be also the fifth straight month of negative returns for Dixon. It's down 19% this month, and it's been declining ever since the month of August itself. Now CLSA earlier this morning came out with a note. It's cut its price target on the stock to 15,800 from 18,800 earlier. It says that the near-term outlook is cloudy, primarily because of two reasons. One, because the smartphone sales volumes in India are tapering down and its key clients are losing market share. Those are the two concerns why the near-term outlook is cloudy. Now it expects the third quarter revenue to remain flat on a year-on-year basis for Dixon, and it is expecting a sequential decline. And if that happens, that may pave the way for the company to cut its FY26 guidance as well. Therefore, it has cut its price target, although it remains constructive for the medium term. And something similar was highlighted by Morgan Stanley as well earlier this month. Now, at the current market price, only three brokerages have targets lower than where the stock currently is. Morgan Stanley is one, Goldman Sachs is the other, and Phillip Securities with the lowest one, which is almost 9,000 rupees. Although the street still remains skewed towards optimism, with more than 27 analysts still recommending a buy, and considering the fall that the stock has seen, the consensus estimates of price targets is implying an upside potential of close to 51%.
Hormuz, thanks very much for that. High was what? I mean, up north of 19,000 and now under 12,000 odd rupees now. Parag is still with us. Parag, in a way, kind of sort of, one of those things which we were talking about FOMO and buying into, into a frenzy. I mean, that usually leads to a very subpar result, and this is a case in point, maybe, price-wise.
Absolutely. Yeah. So, for example, to pay 75 times just because the company is showing 2-3 quarters of 40-50% growth, I think it just defies my logic. To pay 75 times means you should expect at least 50% growth for lifetime, not 2-3 quarters. So the longevity of growth also matters, right? It's just not 2-3 quarters for which you are paying 75 times the company's earnings. Today it is 55 times after the correction. So I would say that, sometimes people just get carried away, and this is what happens then. And I would say that in quick commerce also, for example, see, anything which does well attracts a lot of attention, lot of, I would say, market. So for example, quick commerce, we are giving such a big market cap for loss-making businesses. Now everybody is ready with money. So everybody further compete and fight in the marketplace. Why are investors funding them just to create war chest to fight against each other in the marketplace? That I don't understand. And now, though, I think their employees are also not happy. And now we have seen the CFO exit also. So I think all these things this just defies my logic. Even if, for example, if I am a fund manager, I am saying that I should look at my own portfolio and say that some of the stocks which are available at 52-week lows after this mid-cap and small-cap correction, and if there is any traction in those stocks, I should buy them rather than giving the money this company just because it is in fashion.
It's a point well taken, Parag. So it's a
they might have a long-term runway of growth, but currently the problem is that
I completely take that point. But the basic point we were making, right? Don't look at what is doing well and what has been doing well because money at the end of the day in markets is made by living in the future, not living in the past in that sense, right? I mean, so looking at sharp returns and expecting that to continue, perhaps not the best way to go. Parag, just two things. FMCG, very briefly, Sanjeev Prasad made this point. His point was very simple. Even if these companies, pure FMCG companies, if they were to grow at, say, 7-8% for the next decade, because they're trading at 50 times earnings, it's possible you don't end up making money because there will be some P multiple derating. That is one. Briefly, if you can respond to that. Second is Coforge. I wanted your view on, because that has come off a little bit after the deal announcement. There was a call yesterday. Any thoughts? And I think you briefly mentioned it. Go on.
So first of all, a point on FMCG, right? First of all, FMCG, although grow at say 10%, the growth has bottomed out, margins has bottomed out, at least for companies like Godrej Consumer and Home, where I have done my channel checks, and some seasonal spikes, as I said, on Dabur Imami kind of things. The other point which I would like to say is that, if you remember, Prashant, and give me one more minute to explain this. A few years ago, there were many notes in the market which were floating saying that two-wheeler industry is dead because the industry is fully matured. So how much growth rate you assume for your DCF to give them 25 PE?
Correct.
Look at what TVS Motors has done. TVS Motors, I remember when I was in ICICI Pru, was trading at 530 rupees. And this is not long ago. It is, I think 2021 or 22. 530. This has become 3,500, 7x, right? And in this so-called dying industry, this company has grown its EBITDA at 25% CAGR. Right? So basically, you have
But Parag, TVS, right? And I'll take you back even a little bit more further into history. 2014-15, I think it was till that point, it was Hero was the kind of the clear sort of leader, and then and TVS actually started to pick up. But TVS's gains have largely come at the expense of other players like Hero, largely Hero, right? So it's market share gains. Industry has not grown. Industry has grown at very low single digits. Yes.
If you take a very broad helicopter view and say that this industry is not going to do well for many, many years, you have to deep dive into those companies, I would say companies' efficiencies, right? Like TVS, what they did, they launched every product at a right price. They gave excellent quality experience to their customers. So word of mouth attracted a lot of customers. They gained market share. They developed exports. They did well. They improved margins by cutting costs. So, you have to go bottom up. No? You have to buy, which is ignored, right? TVS Motors at that time was ignored stock because it was optically expensive, but it was doing great things, which actually yielded results afterwards.
Yeah.
I would say that, so just to say that,
No. Blanket statements, absolutely, or absolute generalizations are, sometimes people make them it's like an exaggeration to make a point. But
and I completely respect Sanjeev Prasad. He is far more knowledgeable than me. I'm not arguing.
No. It's a market is a world of ideas, right? And opinions, and that's what makes the market. That's what makes it more interesting. But take your point, Parag. Really appreciate it.
And coming on Coforge. So, for example, just to put this in perspective, if you are wearing an IT analyst hat, you will say that Coforge has paid, 20 times EBITDA. So what it was trading at is paid. So there is no EPS accretion for 1 year at least. So if you are wearing an IT analyst hat, it is okay. But if you are wearing a fund manager hat, just imagine they have actually complemented their strengths, right? By bridging the white space, bridging the gap. Right now, the 80% of the merged entities portfolio will become AI, data, and cloud, which is futuristic, right? They are getting more 10 million plus dollar customers. They are entering into high-tech vertical, which was not there with them. We straight away with the entry point of $170 million revenue, right? So they have to bite the bullet to be future ready. Plus the incoming investors, Advent and Warburg Pincus, they are joining with Mr. Sudhir Singh in this journey, right? And the entry point is 1,815.
Yeah.
Right. So they are also actually aligning with Mr. Sudhir Singh's strategy. And so this guy has shown again a double-digit growth and industry-leading growth.
Yeah.
And the merged entity is going to make 14% EBIT margin. My batch says that EPS of 52 in FY27 on a merged entity pro forma basis, and about 60 rupees in FY28. So it is not that expensive stock, 26 times FY28 for a mid-teen EPS growth.
Yeah.
And about 20% ROE, ROC. So, when you are paying 1 lakh crore for losses, 20,000 crore for 1,100 crore EBITDA, I don't think, if it is a complementary or and a much futuristic acquisition, I don't see any problem in that.
Got that. And I think good, forceful remarks. That's what's needed. Strong opinions backed by numbers. And that's the reason why I asked you about Coforge. It's come off the highs and maybe there's a bit of an opportunity. We'll see. Parag, thank you very much. And if you don't see you before the closeout of the year, and wishing you, your team, your family, very happy New Year. Thank you.
Thanks.
Thank you. We'll take a break. We're back in just a bit. Opening rates will be with us. Some technical trading ideas. Aditya Valekar of Axis will also talk to us about what's next for the steel sector in 26. Stay tuned.
Welcome back. 14 minutes to go, and then we start the day's action. The indications are that we'll again have a quieter start, and maybe the Nifty slips below the 25,900 handle as well. Yeah, it already in the pre-open session that's kicked off, it already is below that mark. So good time to bring in Sudarshan Sukhani and Mitesh Thakkar. Gentlemen, good morning to both of you. So getting all set to wind down 2025, but the bears are not relenting. They've still got their grip on the index. So would there be a trade at all on the index? Because now it's coming towards the lower end of the recent band, right? So I don't know. Sudarshan, let's come to you first. Would you look at buying the dip?
Good morning. No, unfortunately not. The Nifty has broken down below 26,000, 25,950. Now it's in a very narrow, tight range. Let's call the range 25,800 to 26,000. So in this 200-point zone, there is really no trade. It can come to 25,800, find some support there. Maybe it will just stay inside this small boundary for some more days. It's very difficult to anticipate that. Much easier to say the Nifty is not a trading opportunity inside this band of 25,800, 26,000. Focus on stocks.
Okay, so Sudarshan's very, very clear. He's not looking to trade such a narrow range, not looking to buy the index. We'll come to stocks in just a bit, Sudarshan. Mitesh, what's your view first on the Nifty?
Yeah, good morning. I think very similar. We've been talking that this market is ranged, and therefore, you should look at buying towards the lower end of the range. For me, that is around 25,800, 780. Maybe, around those levels, we'll look to explore some long positions. But for the timing, otherwise, the index is giving no direction sense. The volatility indicators are all flat, which means that we might not see a breakdown or a breakout in the next few days. Maybe, after a week or so, I think, there might be some signal.
All right. So what are the individual stocks that you're backing today, Mitesh?
Morning, Mangalam. I have a mix of buys and sells. On the buying side is Grasim with a stop at 2819. Look for targets of around 2890, 2895. Bharti Airtel is a sell call with a stop at 2105. Look for targets of 2040 here. Similarly, we had a sell on Adani Ports yesterday. Adani Enterprises also has broken down of a contracting pattern. Could see some more corrections. So sell with a stop at 2226 for targets of 2155. And the final buy call is on HPCL. Buy on mild decline, say around 471, so 2-3 points lower. Keep a stop at 464. Look for targets of 486.
All right. And Sudarshan, you were pretty clear on stock-specific action. So are you looking to hedge by going a long and a short, or are both your trades directional?
Actually a mix, probably both. And that tells you the confusion.
Exactly.
Also. CanBank is a buy with a stop under 145. ONGC is a buying opportunity with a stop under 230. I also have 2 intraday shorts, so that balances out. Unfortunately, TVS Motor is now giving signs of exhaustion. I say unfortunately because it's a blue chip. We just heard about it. Anyway, it's an intraday short with a stop above 36.50. And Angel One is a much longer short maybe with a stop above 24.50.
Okay, all right. Got that, gentlemen. We'll come back to you a little closer to market opening. For the time being, we're putting the spotlight on the metal space, which has been shining bright. In particular, we're looking at steel right now. Metal stocks, of course, were up and about yesterday, and a lot of them managed to actually go home with gains. Some cooled off, but the likes of SAIL, etc., for instance, were still on the higher side. So now the question is, what will 2026 have in store for the metal space? We've got Aditya Valekar joining in to talk about the trends ahead. He's Senior Research Analyst, Metals at Axis Securities. Aditya, thanks very much. I mean, though we want to put the spotlight on steel, for a second, if you could just tell us what's happening in the broader metal space. I mean, stocks like Hindustan Zinc have skyrocketed 30%, tailgating the rise in silver prices. Something like a Hindustan Copper that usually the market doesn't look at. It's been rising to, again, as a play on copper. Are these just short-term trades, or is there a fundamental reason to look at some of these base and precious metal plays from an equity perspective?
Yeah, good morning, Sobhi. So I think we can divide the metal space in clearly two zones. One is the non-ferrous and then is steel. So non-ferrous, as you rightly pointed out, we have seen structural rally in copper, silver, and even zinc prices have remained elevated. So rightly so, Hindustan Copper, Hindustan Zinc, they have a high correlation with their underlying commodities. So the stocks have rallied. And there is a fundamental reason for that. There are structural demand drivers for copper and silver both. And there are supply disruptions going on across geographies for both copper and silver is also structurally in a deficit since last couple of years. And going forward also the supply demand dynamics is skewed towards deficit. So from a fundamental perspective, both these commodities will trade at an elevated level and the stocks have rightly re-rated at a upper band of their valuations.
So the question,
yes.
Just a question, just to complete this, we'll come to steel in just a second, Aditya. Let's pull up the stock prices actually, because it's absolutely gravity defying, simply because of the play on the underlying metal. Hindustan Copper is up 95% this year. A bulk of that gain, 50%, has actually happened in just the last 1 month. Look at Hindustan Zinc. Hindustan Zinc is up about 26-27% in the month. It's up about 40% for the year. Let's pull up the longer-term charts if we can. Those are, of course, today's pre-open rates, just to give a sense of how the price rise has really happened. And even something like a Vedanta, which is a diversified metals play, also undergoing corporate restructuring, is up about 33% this year. So the question, Aditya, that I have is that all the excitement and the underlying factors, shortage of silver, etc., is it all firmly captured in the price? Or would you say that people can still go and buy these stocks?
If we look at the valuations have caught up most of these fundamental triggers. So let me give you an example. So Vedanta is now trading at 5.5x its 12-month forward EV/EBITDA, and historically it has traded at 4.9 or less than 5x. If we see globally, Alcoa is now re-rated to 6.5x versus its long-term average of 4.5x. So if we look at the valuations, Hindalco is now trading at almost 7x against its long-term average of 6.5x. So most of this positive flow in the commodity prices has been captured by the market. So now the upside will only depend upon further rally from at this elevated level. And that is very difficult to speculate what will happen, because aluminium prices, if you see, they are already very elevated at trading in the range of $2,900 to $3,000 per ton. If any further disruptions happen from the supply side, then the prices may rise and so the stock prices may rise. But it is a very difficult call at this level.
Yeah, got that. Aditya, hi, morning. So just to ask you, so the call is about the underlying base metals. What are you most bullish about?
So structurally, aluminium looks less speculatively traded, and from both supply and demand side, it looks more stable and structurally sound, because China has capped its capacity to 45 million tons. The smelters are not coming in rest of the world because of the competitive sourcing for power. So we may see that one more smelter, Mozal in Mozambique, may go down.
And what's the best play on aluminum? According to you, will be if that plays out?
No, it has already played out. The Mozal smelter has been out, and because of that, the prices are finding support. And then alumina prices, the raw material for aluminium smelting, I
get that. Sorry, Aditya, just short on time. My question is, what's the best play if the call that aluminum perhaps is the best position for more gains from a stock perspective? What's the best play there?
So Nalco has rallied, and most of it's in the share price. Hindalco remains. There remains some upside to Hindalco, so 10% upside. We have a target price of 950 on Hindalco.
We are, again starting to see things, that word commodity super cycle thrown around once again. So I don't know if it is just a function of looking at recent past gains and kind of extrapolating that, or if it's really going to come true. I remember a couple of years back, copper it had not yet broken 10,000.
The interesting part is that I've heard the term super cycle a couple of times in the 10 years that I've been there. So it's definitely not been a super cycle, maybe. But Aditya, do you believe that this time is different?
So this super cycle is not broad-based. The steel is not reflecting any super cycle because steel is dependent on there are different demand dynamics, and China is still exporting a lot of steel, 100 million tons plus this year in 11 months. So the rally is mostly in base metals and precious metals. So it is not something the super cycle which we have seen when the Chinese property sector was picking up. So that was a very broad commodity super cycle. This time around, it's copper, silver, and aluminium kind of super cycle.
So steel, is there? Do you see at all any upsides? Just to conclude the conversation, Ferris, is there any point putting money in steel stocks?
So the steel stocks have not participated in the rally as what non-ferrous stocks have done. So there are two reasons. The steel prices have remained muted. Just last week, the news flows is that the steel mills have taken hike by 500 to 1,000 rupees for steel long and flat both. But still, the exports, especially with the CBAM coming in Europe, the exports outlook is slightly muted for calendar year 26. And domestically, a lot of capacity is coming in. So the prices may remain subdued, but then most of the steel stocks will hike, means they will go for expansion. So the volume-driven story will continue for most of the steel stocks. The prices will remain muted or maybe range-bound.
Yeah, it's a good conversation. Appreciate you joining us. Wish you a very happy New Year. Season's greetings. Appreciate it. Thank you. All right, 9-10 calls. Back to Sudarshan and Mitesh. Gentlemen, morning and season's greetings to both of you. And happy New Year. Of course, we'll meet tomorrow as well. But Sudarshan, what do you have?
Well, it's CanBank. Buy Canara Bank with a stop under 145.
Okay. And Mitesh?
I'll go with the buy on Grasim.
Grasim. Canara Bank and Grasim. Thanks very much. Well, let's talk about Petronet LNG, where there is a call. I mean, remember, as we were going through 25, there were forecasts coming in that 27, 26, 27, etc. I mean, there will be a glut of gas. And I think that is some of what this brokerage call, this upgrade, seems to kind of sort of lay its foundation on. Sonal is joining in with what they're saying. Sonal, morning.
Good morning, Prashant. Well, of course, when we talk about LNG, Petronet LNG is one of the stocks that we focus on, which is Investec's top pick in 2026. They have a buy rating with a target price of 400. As we mentioned earlier, there is an expectation that global LNG supply will increase sharply in 2026. It's an uptick of 7%, which is expected, and which will be the fastest growth seen since 2019. This surge is primarily driven by new capacities which are coming in the US, Canada, Qatar. We have African producers as well. And now the supply will far exceed the demand, and that's the reason LNG prices have been quite subdued. Investec says that this benign pricing environment comes at an opportune time for India because we did see LNG imports falling in FY25 due to temporary factors. They are now stabilizing, and now pricing is also coming down. So, of course, we'll see more imports as well. This will mean that more imports will be positive for Petronet LNG because it imports that gas and regasifies and passes it on. So, lower spot prices should help revive price-sensitive industrial demand from early 2026. A couple of factors which will work for Petronet LNG, that the Dahej expansion is complete. They have contracted volumes as well for their sales, which will provide downside protection. And they do have superior connectivity across the country, right? So that is something which works in favor of them. So after an 18% correction over the past year, Investec now believes that it trades below his historical valuation band, and this is the right time to buy this stock. And that's why they're quite bullish on this counter.
Okay, all right. Sonal, thanks very much for that. So Petronet on our radar. Stocks doing okay in the pre-open, gain of about 1.25%. Otherwise, things are so quiet on the index. Would you believe it? I mean, it's just a 1-point move on the Nifty. That's all that we are getting. I'm just looking at some of the stocks like Interglobe, which have been in news. The company is finally looking at hiking pilot salary. Minor dip, 0.3% lower on Interglobe. And on Shriram Finance, there's a 0.5% uplift. because one of the rating agencies has gone ahead and upgraded Shriram Finance's debt. So that works well. So those are some of the key stocks that are reacting to news. Lupin has done a semaglutide tie-up with the Chinese company. So keep that on the radar. For the time being, it's up 0.5%. By the way, all the stocks that we were just discussing, metals, all of them quietened down.
Okay, well, first rate's coming up, 25,950, 35. So just sort of starting up with not very much gusto at all. Nifty Bank is flattish, 0.13 odd lower on the Nifty Bank. The sensex is down 0.14. Small cap index is down about 0.16. And so it goes. So kicking off this Tuesday's session right now. Look at the advanced decline. I mean, it's too early, of course, with markets so slow. I think it'll take a little longer for everything to start to trade. But it's almost 1:1, advances to declines, right out of the gates, almost completely balanced with how many stocks are higher and lower. Nifty heat map gives you a quick sense of how the 50 stocks are opening, how many up and how many down, and then we will take it from there. Shriram Finance, once again, is the top gainer after that ratings upgrade. So, I mean, obviously, there was nothing unexpected in that sense. It was cost of capital coming down sharply for Shriram Finance. Was one of the big expectations at the back of which the stock re-rated. But it's doing well once again. So 1.7 higher on Shriram Finance. On the other end is iSure, Apollo Hospitals and Coal India, which are lower. So you got, almost 38, 39, 37 odd names which are lower, and the remaining which are in the green. But 40 points lower is the start on the Nifty, 25,900.
Hard to find any movers, really. What to say on the screen? Okay, let's see where the pressure points are. So Eicher Motors, like Prashant pointed out, 1% lower there. L&T is very sluggish this morning, down about 0.7%. Bajaj Auto, keeping Eicher company in terms of the two-wheeler space. That stock's also slightly lower. Titan, well, no sparkle of the lab-grown foray, not yet at least, 0.5% lower on that stock. There's Coal India, which is down. Interglobe, like I mentioned, is down about 0.5%. Tata Steel is cooling off. Yesterday, Tata Steel managed to clock some gains towards the end, but they're coming off now. Eternal, the stock that Manglam was highlighting earlier with the CFO of Blinkit resigning, that stock's down about 1%. So that's what we have. Shriram Finance is the clear leader, 2% up. There's some buying on Tata Motors, a little bit of buying on BEL. Yesterday, by the way, none of the defense stocks reacted to the DAC 80,000 crore rupee acquisition proposal. Not sure if that's reversing, but BEL for sure is not showing any action. Bharat Dynamics, etc. Most of them on the flattish side. 30 lower on the Nifty.
30 lower on the Nifty. You know, what's interesting is that for every stock from a sector which is gaining, there is an equal amount of stocks from that particular sector which is declining. So we're talking about metals, seeing some bit of profit booking or being absolutely flat. You have Hindustan Copper, which continues to do well. So Hindustan Copper is higher. NMDC is higher by about 0.8%. But then you look at some of these rare earth names, or you go down the ladder, you see, something like a GMDC, which is down about 3%. MMTC down about 3.5%. We have, HEG, another metals play, which is lower by about 3%, 3.5% right off the gates. Then you have a bunch of these new age companies which are doing well. But for every of those, we have a Nykaa, which is slightly under pressure. Indian Hotels and Interglobe Aviation are lower, but then you have Yatra, which is higher. So it is totally, mixed. I wouldn't even call it divergent and uncertain, undecided as of now. And that's what's reflecting in the kind of moves that we've seen in at least the first 3 minutes. So let's see how that goes.
Absolutely. So no real trigger push in that sense, one way or the other. So 25,900 kind of treading water. 58,800 something on the Nifty Bank as well. Nimesh Chandra is with us, Chief Investment Officer, Bajaj Finserv AMC. Nimesh, good morning. Season's greetings. Wishing you, your team, your family a very happy new year. What will bring the happiness in 2026 from a stock return point of view, Nimesh, though? It's kind of I was just wondering, right? I mean, I was off for a week and it's almost people have stopped talking about or even asking the question about this India-US thing. It's kind of gone to the background. Just because nobody's asking the question doesn't mean it's not important in that sense, right? What's your sense? What will be the trigger? Is it the plain earnings recovery? I mean, not to be scoffed at, But you think we need something more for this market to do well?
Good morning, Prashant, and season's greetings to you, your colleagues, and your viewers. Yes, it looks like a bit of a quiet end to a very exciting year, and I think people can enjoy that too. The sentiment actually is a bit low because of all the events that have happened this year. Otherwise, if you see, when I look at the economic cycle, we are in an upturn. The business cycle or the profit cycle of corporate, we are starting to see upgrades now and a much better outlook for next calendar year. And if you look at the credit cycle, that has also picked up. So asset quality is benign and you are seeing pickup in credit growth. Margins, at least for NBFCs, are doing better. Banks will slowly recover after they price in all these rate cuts. So I'm actually seeing the fundamental cycle, that is the economic cycle, the profit cycle, and the credit cycle doing well. It's the sentiment which is down. And I think what US-India trade deal can do is just offer that, a positive sentiment. Numbers-wise, I don't think after doing this deal, we will see any upgrades or major changes coming in the market-wide. Maybe some specific companies will definitely be benefiting from that. But overall, I think India is on a very positive footing. It's the sentiment which is a bit low right now.
Yeah, but one sentiment also is important, right? Feel good in that sense. But also, obviously, there are tangible reasons. There's no earnings upgrade. But if you're if what has been 25 about? 25 has been basically about each country kind of looking out for themselves, building up their own. It's not just America first. It's like every country first for themselves. So you want to be kind of aligned with what has been a natural ally, right? Because it's not just about getting business, but so many other areas, right? So it's sentiment, of course, yes, it's a big one whenever this happens. But even otherwise, I think it's important, isn't it, Nimesh?
You're absolutely right. 2025 has been a year where, earlier we used to say that it's the markets that make headlines rather than headlines making the markets. But 2025 has been quite the opposite. It's the headlines that have driven the market. And the way these announcements have come, they have hit the sentiment quite bad. And because not only from the trade perspective, as you mentioned, people are looking at it from a geopolitical standpoint also, that are the relations between US and India strained. But I think if you look at the commentary from both sides, it's just that we've not agreed on certain terms of the trade rather than disagreeing with broader geopolitical issues or economic issues. I think there were a few points which maybe agriculture or so, which was a bone of contention for signing the agreement. Typically, these agreements will take time. I think the bigger agreement that we will sign will be with EU, because it will not only cover goods trade, it will cover services, it will cover investment, immigration, all those will be covered. And EU is the largest trading bloc in the world. So I think these things will get resolved. See, typically, when economic cycle or the fundamental cycle is doing well and the sentiment cycle is down, those are actually opportunities where you can actually go and invest in the market, because these are the situations that typically precede a good rally in the market. So I'm quite positive as we move into 2026 for the equity market.
I have a personal vested interest in the India-EU FTA. Like Chandan is saying, I'm also eagerly awaiting it, waiting for all the French wines and the Italian wines to hit our shores at much more attractive pricing, right? So yeah, that's going to be a big one indeed for things beyond wines, for sure. And maybe that'll make up for the fact that we are yet to negotiate this trade deal with the US. Take your point, Nimesh, entirely. I want to now talk about your portfolios and what you're doing and how you're sort of navigating this slightly confusing market landscape. And I was going through your December fact sheet. So it clearly says that overall, at a portfolio level, you guys are liking domestic cyclicals. And you're also seeing opportunities in consumption because the policy environment has been so supportive, right? Rate cuts, income tax cuts, GST cuts. So let's drill down on this one by one. When you say consumption, that's a very big basket. So what part of it are you most bullish on? There are jewelry companies that have done very well in the past. There is an entire platform play, quick commerce, so on and so forth. That has its own issues with respect to cash burn and profitability. And then, we had a guest earlier on in the show who actually gave a positive call on just pure vanilla FMCG. just because it's so under-owned. So I don't know if there's any sense in looking at that. So divide your consumption thesis into all these pockets. There's travel, there's hospitality. So what part of consumption do you like and why?
So let me just quickly lay the context first on consumption. We are seeing throughout this year the income effect come because of income tax rate cuts that were announced in the budget. Then we saw savings impact coming because of the GST cuts that were announced. We've seen the wealth effect come because of the gold and the silver prices moving the way they have moved. Also, there is a bit of leverage impact also because interest rates have come down and we've seen banks and NBFCs willing to grow their credit. So this is the context where consumption can do well. So we are positive everything from daily groceries, FMCG, quick commerce to about real estate. So we are across the board. Now, here then we have to see what is priced in, what sees better upside than the other, and what are the risks to this. Now, typically what happens when you're very bullish on consumption, you don't directly load up on FMCG because FMCG, you know, has its slow growth. It is a bit of defensive also because during economic downturns or slowdowns, it doesn't get affected so much. So you don't really load up directly on FMCG. You pick certain companies within FMCG staples which have higher growth or seeing some turnaround in businesses. So maybe some companies which are into aggressive growth areas, you can give them more benefit. And also quick commerce in a way is daily groceries and delivery. The second part is consumer discretionary. This typically does very well during consumption upturns. Typically, the first to move are automobiles. And we've seen that happen this year. The auto stocks sharply rallied from there. Then we see pickup in the other, during festive times and during wedding season, you see pickup in other discretionary products, and which will probably now we'll see in electronics, in consumer goods, white goods. We will see that coming in this quarter and next. Also, maybe we'll see a good pickup in paint, the volumes, as well as because of the slowing competition, some of the companies may actually deliver better margins also.
You think on Nimesh, on paints, you think the worst of the whole competition, the price wars, all of that, is the worst of it done? And then would you go back to the existing, old established giants, or that's an interesting call. So just asking you for more details there.
So we actually became bullish on real estate. We became bullish on the rural as well as urban consumption theme, and paint somehow fits very well in there. And we saw initial pickup in volumes also in the last quarter. The competition slowing down its aggression is definitely seen, and last quarter numbers are showing that. So there is no aggressive player who is let's do anything for market share. We are seeing the regular competition, which is a little more measured and little more sensible competition. So we are seeing an upturn in the paint industry where the volumes have now started to pick up and pricing is not that aggressive. Add to that a benefit of the raw material cost, where now we will see improvement in margins coming also. So few important parameters of this business are actually falling in place for us to become positive. And yes, we are there with the leaders in this pack rather than the challengers.
All right, with the leaders, and the leader has shown a remarkable recovery from the lows, notwithstanding the underperformance that we've seen over the last couple of years from a shareholder return. And speaking about shareholder returns, an interesting stock this morning is Honasa. That's the one that should come up for you, down almost 3%. There was an interesting block deal that took place yesterday on that stock, where Fireside Ventures, the early investors in the company, sold out, and the buyer was Varun Alag, who's obviously the promoter of the company, the founder of the company, along with Ghazal. So the street would have thought that, with the promoter buying and the fund exiting, there could be a bit of a pop. That's not the case to be. The stock's down about 2%. The other part of it is also, it's way lower than its issue price of 324. So any sort of up move on this stock is met with a firm amount of supply. Nimesh, on these new age offerings from the IPO market, valuations are extremely high, but so is the long growth runway and the opportunity, the underlying opportunity. Where on the spectrum are you when it comes to this pack?
We are very positive on this pack. So digital consumer plays, we are very positive on. Yes, what we have in the portfolio is something or those companies that meet our criteria where growth and valuation both fall into place. So we want certain companies which have good scalability for growth, customer ownership, certain moat or certain competitive advantage in the business.
Where in this place are you finding growth and valuation both satisfactory?
Yes. So in some of them, actually, the correction has been quite sharp. I mean, quick commerce has seen a very sharp correction already in terms of prices. Some we have been able to pick up at, see, initially there was a euphoria in their listings and all, and then they have now corrected. Some of them have corrected to that level where they become interesting bets. And typically, see, today the investors are less patient because after COVID, they've made money every month. So they become impatient. If a company underperforms for one quarter or has some challenges for the short term, people tend to trash those companies and throw them at a valuation which is very low. And people actually are too disappointed with one quarter numbers that they change few years numbers. So those become opportunity for patient investors like us to pick up some of these companies. In many of these companies, you have to also dwell down in terms of the exact their P&L, in terms of what are the gross margins or what are they spending on customer acquisition, and how long will those ad spends or customer acquisition costs remain, whether they are trending down or trending up. So you have to do business by business analysis of those. But clearly, these are businesses which have huge runway for growth, and many of them are run with good management and have good moats. So we look at those, and you won't get them extremely cheap, but we want to pay a reasonable price for them so that we get a good compounding.
One of Nimesh, I'm sorry, I'm just taking a chance here. A couple of weeks back on Editors Roundtable, I think you were on and we discussed in these beaten down names, etc. Construction is a space, right?
Yes.
And I think one of the names which Nimesh put out, he put out a presentation of damage across stocks was KNR Construction. Was as one of the names that I'm not sure if that's the name that you like or have looked at, but I mean, just to use an example, those are those are spaces where you focus on, not spaces, but the kind of situations you would focus on.
So construction is a space we are now constructive on. So I don't know how that sounds, but we are positive on
constructive on construction.
And I won't comment on a particular name. Won't comment on a particular name, but people generally with the name Nimesh are very smart.
People with the name Nimesh, nice one, huh? You're on a roll, Nimesh. So, okay. Would you like to talk about, I mean, if you've looked at this, I mean, with full disclosure, not as a recommendation to buy or sell or anything, but have you done the work on this one or others?
Yeah, so what we do is we have certain screeners which actually give us contrarian picks in the market, where, say, companies which have underperformed for 3 years, 5 years, fundamentals have not deteriorated as much as the valuations have deteriorated. People have got disappointed because of certain short-term issues that the business cycle is going through. And typically, if you see, these were construction companies which were stars during the 2003 to 2008, 2007 rally in the market. Typically, these old old stars who are underperformers for the recent cycle, there is an opportunity or there is a chance that they may come back. So we want to look at them dispassionately and see whether there is an opportunity within these fallen angels or within these companies which have fallen sharply. Now, if you see in the construction space, in a couple of names that you mentioned, these guys have reduced the debt on the books or have sold off some of the projects that were hurting their P&L, cleaned up their balance sheet. And the order flow has started coming in well. As some of these areas like infrastructure development, real estate constructions, as these pick up, some of these construction companies would also do well. So these companies come as deep value picks. We have chosen very few where we are confident that the business model is good, the management is good, and they have taken an attempt to clean the balance sheet and improve their order books. So those we are picking up. A lot of real estate names are also coming now as underperformers for some time. Their stocks are down like 30-40% from their 50%. Right? And with low interest rates, mortgage rates being so low, it is likely that we see a pickup in real estate. So these are companies which are ancillary to infrastructure, real estate, and we like them.
Okay, so construction, real estate, and the further sort of derivatives of real estate, like you mentioned, cement, paints, quite interesting. So we have a fair enough idea about the way you're thinking about 26 and the way the portfolio is positioned. Nimesh, thank you so much. Great conversation as always. Wish you, your teams all at home a very, very happy new year. And we look forward to connecting again soon. Thank you for joining.
Do the same. Thank you.
All right, with that, it's time to move on and get to some corporate conversations. Before we do that, just a quick check on the screen. Nifty is down about 36 points. Mid-cap index is looking at a 0.25% cut at this juncture. So it's, again, very, very range-bound, listless. That's the kind of morning that we have. So let's turn our focus to Cholamandalam Investments. That's the next company on our radar. Of course, we want to talk to Cholamandalam about the growth prospects from here. And the company has already clarified. I mean, the last couple of days were all about this Cobra Post report that came out flagging or alleging certain corporate governance issues. The company completely clarified, saying that all of this is completely baseless, and it gave a point-by-point rebuttal to a lot of these allegations that were raised. So we want to move beyond that, talk about the business at large and what's really driving sentiment as we get into 2026. And for that, we have with us Mr. Arun Selvan, President and CFO of Cholamandalam Investment and Finance. Mr. Selvan, thanks so much for joining in. Season's greetings to you. Thank you for joining in. Hope you're set to wind down a good year, because at least for the financial landscape, for banks, NBFCs, it has been a good year, I suppose. I mean, growth has not been too bad. Stock price performance has not been bad at all. So, I actually want to start on a broader note, on the sector note, and then we'll talk about Chola and what you see ahead. This year will be remembered as a year for perhaps seeing the maximum foreign interest that we've seen in Indian lenders in a long, long time. Capital has been pouring in left, right, and center. From the Middle East, from Japan, from other parts of the West as well. So I want to start right there. As you've seen a lot of these deals happen, a lot of them with your peer companies, what is the thought? I don't know if anyone's been approaching Chola. I don't know if you're thinking of shoring up your capital buffers at all at this point. But are you thinking, more equity capital at all as we enter 2026? Are you going to be open to more deals if there are willing partners outside?
Yeah, morning. Certainly, we are open to any new interest in the company, but we always try to be self-sufficient. I mean, the philosophy within the company as well as within the group is that you have to fuel your own growth rather than keep looking at funding outside the system. This is what we try to do. We keep, I've already elaborated that if we grow at around 20 to 25% and we keep our pre-tax ROTA at around 3.5%, it is actually a good, refueling or the self-sufficient model, provided we don't go a little high on the dividend, which we never have gone to pay, exorbitant or high dividends.
Mr. Selvan, you're saying that you would be open to conversations.
We are open to conversations as long as it provides a meaningful, positive impact to the company. But we are right now not looking at any conversations at all.
So there are no current ongoing conversations, but you would be open to shoring up equity capital.
Yes, it is always a good thing to do. But as you know, I am the CFO and there are more people above me, board is there and others who will also have a say on this. But I know the sentiments that if required, there is always a positive, and there has been no resistance on bringing equity if the terms are good, and we have brought equity many times in the past. Over the last 15 years, I've been myself participating on many equity issuances, and we are open to it. There is
okay, you are open to it so long as it meets your internal benchmarks of growth, internal benchmarks, the quality of capital and the nature of the money, what the end use of that money would be, whether that enhances your cause, which is currently not particularly bad. I mean, with a 20-25% growth and the return ratios that you've set for yourself, you're self-sufficient, but a little bit of propellant would not be bad so long as it's the right fuel. Okay, you are the CFO, so let's talk about the businesses that you are looking at directly. Which segments do you believe that will need a bit of a push for disbursement? Because there's housing, home loans that have been a bit draggy, and then at the same time, the vehicle book post GST cuts. How has that business panned out? So if you could give us some color on each of the segments that you are, disbursing loans to, and how the health of that underlying industry is, specifically speaking from your standpoint.
Yeah, actually vehicles have started moving up. We are seeing disbursement growth in double digit, and this quarter will be a good disbursement growth compared to the first 2 quarters. You will see the growth coming up in this quarter. LAP has always been growing, steadily at around 25 to 30%, and you will see the same 30% level of growth in LAP disbursements and LAP AUM. Home loan, which saw a little bit of a moderation in Q1 and Q2 because of various issues which we had discussed, will again show growth in this quarter, and you will see the growth coming in the home loan segment also. The SME and the CSEL, as we have spoken earlier, we are doing some corrections in this. While in the SME, we have reduced the supply chain finance. So the disbursement numbers may still look a little lower, but AUM growth will be there. CSEL, which is our unsecured funding book, will also show growth, but it will be moderate as compared to the previous years. SBPL will show a good growth, about 30% plus. So we see overall a good traction, and we see 2026 also to be more positive, especially Q4 will be more positive.
Could you give us some numbers to quantify that? Because the second half of this year, the street really wants to know what's the kind of disbursement outlook that you have for the second half of this year. And if you could give us an AUM target by the end of this year and by the end of, FY27 as well.
Yeah, right now I'm not moderating any of the AUM target. See, AUM is something which is like an elephant. It moves slowly. Disbursement will move. When disbursements slow down, AUM did not get impacted. Same way, when disbursements, grows faster, within 1 or 2 quarters, it will not show immediate impact. So we still would like to retain our outlook conservatively in the 20 to 23% growth levels on the AUM for the full year of 26. And 27 is a little far away. We need to see the impact of the H1 of 27 to understand how the seasonality plays out for the year 27. But right now, outlook is little positive, but it is little too premature to commit any growth numbers.
So will 20% plus disbursement happen in the second half? Because, for you to achieve 20% AUM growth, you will have to
certainly clock anywhere above 15% overall growth in disbursement. 15 to 20% certainly will happen in the second half. On disbursement, AUM will be in the 20 to 23% year on year at any point in time. And 27, we will see similar 20% plus growth on AUM. Right now, that is what I would like to keep it at. And then we will see as we go closer to the 27 financial year.
Right. Mrs. Hilman, good morning. Prashant here, Seasons Greetings, sir. Just a quick question. I mean, there was a big difference in cost of funds between you and Shriram Finance. With this big deal, their cost of funds are expected to come down sharply. Do you expect, in specific segments, increased competitive intensity?
See, we and Shriram play in different segments, actually. We are, in new and even in the used segment, what we play is the used vehicles which are less than 10 years on maturity after our loan expires. Well, Shriram plays more in the little longer used vehicle segment. We need to wait and watch how they would which markets they would like to enter, post this new money that has come in, and what is the what is the direction MUFG sets them to move forward in. I don't think that would be a big impact for us in ways of our growth. And today we are not necessarily focused only on vehicle finance. We have grown books in other parts of the business, so we are not unduly concerned about it.
Unduly concerned, but yeah, vehicle finance is perhaps one area. But I mean, we got most NBFCs now not as, I mean, sector champions, but also doing many other things, right? Like you, and of course, I mean, Shriram now also is doing other things, and perhaps will do more things with this capital infusion. So just a quick point. Actually, two questions. MSME loans are doing very well. There was a CRIF Highmark report which said that the expectation is that because it's a segment which is doing quite well, public sector banks which over the last 3-4 quarters have lost share in this segment, and this is a segment growing north of 17, 18%, competitive intensity in this space is going to pick up quite a bit. For you, I think you classify this under this new business segment, right? CSEL and SME, MSME, etc. all together. It's about 12-15% of your assets. Do you expect increased competitive pressure here?
See, the CSCL is doing the unsecured segment of the MSME market, and the SME segment does the secured segment of it. These two, as of now, as you rightly said, is overall in the range of around 15% of our portfolio. We may see some impact on the banks coming in, but I think the customer profile, what the banks targets versus the customer profile we work on are completely different. So I don't see the overlap happening between banks and us. The banks are on a larger ticket size while we are on a slightly smaller ticket size. So we don't see this to be of a significant impact to us. Again, we'll wait and watch. Actually, see, SME segment is not such a high profitability segment. It runs on a very tight rota. But the cost of fund reduction would help compete in this segment. So we will certainly try and assess where we need to, make ingress into these markets.
So, Mr. Selvan, just one last question from my side. What's the big, I mean, if I can, how do I frame this? What's from a banking and a finance perspective, I mean, from your business perspective, right? Everybody's focused on disbursement growth and, the usual things. What, to your mind, what's the one big enduring theme, if there is one, for 2026 going to be, sir? What should investors really sort of, stay focused on?
See, always investors' focus is and will continue to be on profitable growth. Growth by alone will not make meaningful impact. Maybe in the short term it's okay, but in the long run it needs to be a profitable growth. That's what we focus on always. Like we want to do and grow segments which are profitable and will also has the potential to keep growing at a pace which is consistent, and so there is no yo-yoing in our performance, whether it is with regard to growth, with regard to NCL, with regard to profitability. So keep the expectations of the investors at a moderate pace and keep delivering them consistently. If we maintain this formula, I think investors would like us and trust us.
No, absolutely. And on growth, you've already reiterated your earlier promise that it will be more than 20%. Very quickly to round up the conversation, sir, when we earlier spoke, you told us that in the second half, your margins should start improving. I think the guidance has been about 10 to 15 basis points. And you had also told us that credit costs should actually come down. Now, off and on, we keep getting conflicting reports. When I spoke to some people who said that microfinance stress and unsecured stress is not entirely out of the system as yet. So just if you could revisit the asset quality and credit cost guidance, and also, margins, if indeed you see this margin expansion playing out in the second half.
Yeah, we will see. Thankfully, we don't have microfinance as a segment in our portfolio. Neither our unsecured segment is a large portfolio. We have seen certain stress in the unsecured because of the fintech exposure, which I am sure it will run down completely, or I would say almost 90% of it would get run down by the end of this financial year. So with Q4, the fintech portion of the unsecured exposure will run down. The rest of the portfolio on the unsecured is running fairly good, and we should see positive impact on that. NCL will come down and NIMs will improve. I'm confident about it. We will have to, so there should be a positive impact on the PPT ROTA.
Okay. All right, Mr. Selvan, we will leave it on that note. Thank you very much. You're sounding as confident as ever. Let's take this opportunity of wishing you, your teams, your family, everybody at home a very, very happy new year. May it be a happy, healthy and prosperous 2026.
Thank you, and wishing you the same. Thank you. Yeah.
Thank you. Thank you so much. We'll take a quick break on that note, come back on the other side. Lots more coming up. And we'll get a conversation going on the entire rare earth challenge. A lot of, the second half of this year was really spent on the crisis around lack of availability of rare earth, and then India swung into action looking at Atmanirbharta. Where are we on that journey? How long will it take? And what are the next milestones? We'll have a panel of experts joining in.
Welcome back. The broader market seeing a fresh bout of profit booking. In fact, yesterday we had 2,000 stocks which were declining. And now as we speak, straight off the bat, we have 1,600 stocks which are lower as against just 980 stocks which are higher. So the crisscross lines, not crissing, not crossing. The red one firmly above the green one as we speak. The mid-cap index down by about 1/3%. But remember, all of this comes on fairly thin volume, so the impact cost is a lot higher. PB Fintech is lower by about 2%. We're also seeing some profit booking in names like PVR Inox, which had a good move in the earlier part of the month on the back of success of some of the movies that came by too. So PVR Inox comes up for you, down in today's trading session. But let's talk about something that was extremely important and the most spoken about in 2025. It was the year where rare earths moved from the margins to the center of global power. Export curbs, supply shocks and manufacturing disruptions, they turned these minerals into strategic assets and actually forced countries, including India, to rethink how to secure their supply chains. We have Shivani Bazaar, who puts a spotlight on this year that made rare earth magnets really rare.
If there's one lesson global markets learned in 2025, it is this: the country that controls supply chains holds the power. Driving home this lesson were rare earth minerals, a small group of elements that quietly rewrote the rules of geopolitics, manufacturing and energy security in 2025. The turning point came in April. China tightened exports licensing on rare earth elements. These elements are crucial for a host of manufacturing activities, from EVs to electronics to military equipments to renewable energy to a range of industrial processes. By October, those controls were expanded further to include magnets and even processing technology. But the impact was visible in April itself. Exports slowed, uncertainty crept into supply chains, and global manufacturing, from cars to clean energy, was suddenly left exposed. This wasn't about running out of minerals, it was about who controlled access to them. Now that's because while rare earths may be a group of 17 critical elements and global production stood at around 196,000 tons in 2025, valued at around $12 to $15 billion, the industries these elements supported were collectively valued at a whopping $7 trillion globally. In number terms, one electric vehicle needs about 1 to 2 kgs of rare earth magnets. One offshore wind turbine can use anywhere between 600 to 2000 kilograms, and a single fighter jet uses more than 400 kilograms across systems and sensors. So in effect, without rare earths, motors don't run and modern technology stalls. In addition, there are very few alternatives to rare earths at scale. So China's move was a masterstroke of sorts, and it caught the world flat-footed because China mines around 70% of rare earths globally and controls 85 to 90% of refining and processing and produces over 90% of the world's permanent magnets. This means that even if rare earths are mined outside China, they often still depend on Chinese processing to be useful. All this makes the supply chains extremely fragile and ripe to be weaponized. Factory floors went into chaos. Global EV sales, for instance, took a hit. Magnet shortage led to cost pressures and production risks. In India, Maruti Suzuki cut its EV production target sharply to around 8,000 units from earlier 26,000 units. This disruption was real. For their use in defense manufacturing, rare earths were firmly classified as strategic minerals, and NATO countries started increasing their stockpiles. Adding to the chaos was the market-driven surge in prices of many of these elements. One striking example is the price of yttrium jumped more than 4,000% during the period of supply stress. And so started a global scramble for rare earths, with almost every country and government entering the race. The US and its allies committed billions of dollars to build non-China refining capacity. The European Union, under its Critical Raw Materials Act, set a target to process 40% of its needs domestically. And Japan pushed long-term supply contracts and recycling. As a result, over 300 million tons of rare earth resources have now been identified outside China. Over 146 projects are already under development to extract and make these elements ready for use. But there's also a reality that none of this will happen overnight, or even in a handful of years. India also found itself at a sticky wicket with Chinese weaponizing rare earths. We import nearly 100% of the rare earth magnets, despite being home to about 6% of the global reserves. India's manufacturing push, on which the government has based the big portion of its plans for Viksit Bharat, was suddenly vulnerable. The government responded with a 7,280 crore rupee scheme aimed at building domestic magnet capacity of around 6,000 tons per year. This was aimed at not only reducing its dependence on China for these elements, but also eventually providing the world with an alternative supplier. As 2026 begins, the global race for rare earths is going to get crazier and well more intense. Global demand for rare earth is expected to grow by around 700% by 2040, driven by energy transition, the global semiconductor push, and the drive for defense and space supremacy. With stakes so high, rare earth minerals are no longer just commodities. They're strategic assets, they're global bargaining chips, they're carrots and they're sticks. And in this evolving new world order, those that dominate supply chains can dictate terms. And everyone wants in on that security that it offers. Back to you.
Well, there's a wholesome, rounded perspective on this entire rare earths issue, and maybe a little peek into what lies ahead as well. But let's get some experts in. We have Sarada Bhushan Mohanty of Indian Rare Earths with us. We also have Nagarajan Mahadevan of Entelis Industries. Gentlemen, great to have both of you here. Thank you very much for joining us. Mr. Mohanty, if I can start with you, sir, and same question I'll ask Mr. Mahadevan as well. You know, we've stopped talking about rare earths as we came towards the last few months of 25. Has the supply started, or has Indian industry and especially the Indian auto industry made other arrangements? Because I mean, I don't recall any big breakthrough with regards to supplies resuming from China or anything of that sort. What's happening? What's the current state of affairs, Mr. Mohanty?
Yeah, currently, thank you very much for the opportunity. Even actually, currently what has happened is this export restriction from the Chinese side with the end user restrictions. So with the commitment that it will not be used for certain kind of purpose, this has already been, some of the companies have already started importing. Some quotas are getting released. Although these quotas are there, but it is the process is a little bit slow. And some of the companies are already getting it. And particularly EV sector, they are getting the material.
Mr. Madhavan, same question. When I asked alternate arrangements, I meant, through, maybe not from China, but basically, what's going on, according to you, current state of affair?
Well, speaking a little bit into the details of the supply chain, I should say, India has complete capability in terms of upstream, which is ores down to the oxide, which is the pink material, which goes into making metal alloy and then into blocks. And finally, you have the value add or the downstream, which is components that goes into electric vehicles, etc., etc. To answer your question, supply has started with reference to my co-panelist, Mr. Mohanty's then oxide supply to us and to people in the industry in India, namely Ashwini as well as Midwest, I presume. Now, conversion of this oxide into metal and alloy on a commercial scale, we have achieved. And we would go into large-scale production probably at a date time in the next calendar year. Speaking of downstream, yes, a lot of imports, only imports are happening. And the trigger point being the Chinese ban sometime in April this year, which brought awareness of the auto industry's complete dependence and also various electric vehicle associated industries' complete dependence on this rare earth permanent magnet. Right. So the focus was being worked on for 2 years, the incentive program. So brought a bit of the whole thing.
Right.
And what panned out is the 7,230 crore incentive. In simple terms, supply started at downstream. Midstream capabilities are there. Upstream has to be worked on completely.
Right.
Independent. Yeah.
That's exactly what I'm a little curious about. Mr. Mohanty, I wanted to know, when you're in the heat of the crisis, there is commentary coming from across the board, and they are in a rush to go ahead and secure our future supply chain. But now that things have eased out a little bit in terms of import availability, etc., do you believe that the momentum which started in the heat of the crisis still continues, or that has fizzled out a little bit?
So actually, the momentum what was there earlier, so that has definitely got affected. But the point is, it has developed one of the necessities, the mother of invention, this kind of situation. Once this kind of restriction was been made, so all over the world except China started looking at the production of this magnet outside China. So on that basis, the government of India come up with this, the MHI released its the scheme, so 7,280 crore. So that will be really a game changer. On top of that, people have started looking at this alternate arrangement of this rare earth magnets. So on that basis, all over all the countries, starting from Japan to Germany, US, all those countries, they are trying their best. And similarly, the ecosystem in India is going to be developed. And now the industries, particularly when those countries which are having the technology like Japan, Russia, Germany, and the US, and South Korea, they are the talks are going on, and in that basis, what is looked after is in India's capability, the making of metals. So from up to metals, they can collaborate.
Mr. Mohanty, Mr. Mohanty, I mean, sorry, I'm coming in over there because I'm glad you brought up that scheme, and we now have full details of this government scheme. The details were released only 2-3 days back. So I just want to take that up point by point. Indeed, the total outlay is about 7,200 and I think 50 odd crores, like Mr. Mohanty mentioned. And the details are as follows. There is going to be a sales-linked incentive worth 6,450 crores for production of 5 years. And the total capacity that has to be set up for rare earth magnets is 6,000 metric tons per annum. And this is to be distributed across 5 beneficiaries through a global competitive bidding process. There's also a 750 crore rupee capital subsidy for setting up these manufacturing facilities. Now, on paper, all of this sounds great, sir, but you tell us operationally, because I remember our last conversations, you said the issues are of technology, and you said that having certain technology tie-ups might be very, very critical. The issues were of certain type of inputs which are required. We might have the reserves, but we need the refining capacities. We require the other additional inputs to convert these reserves into usable rare earth magnets. So I'm not sure if the scheme addresses some of these operational challenges. Your thoughts?
See, basically the scheme is talking about it is inviting 5 different investors will be coming up to maximum to 1,200 ton of magnets can be provided. And minimum is 600 ton and maximum is 1,200 ton. By that way, 6,000 ton, which is the requirement, current requirement is around 4,000 ton. And by 2030, somewhere the 6,000 metric ton, whatever magnet will be produced, it will be consumed in the market itself. So particularly the preparedness of the market regarding the inputs. The inputs, particularly this dysprosium, terbium, which is the heavy rare earth elements, these are not available in India.
Yep.
And this has to be imported currently. And India is also looking for like this hard rock resources. Hard rock resources is having this dysprosium and terbium. But that process will take little time. So in the gestation period, it has to be imported. So that is the one aspect. The other aspect is regarding this scheme, particularly if you see actually this NdPr oxide, we are supplying at the Chinese price, whereas this magnet price at China in India, if it will make it as per our calculation, current market cost it will be around $102 per kg, whereas in China it is $78 per kg. So there is a clear disability available in this around $24. So that alone, and as well as this depreciation, as well as the interest finance cost, because in Chinese capital cost and as well as their capex requirement will be lesser than.
So, sir, I'm sorry, we're running out of time. My simple question to you and the same question to Mr. Mahadevan is, the scheme says that over the next 5 years, we should be able to produce 6,000 tons of these magnets domestically. But given the concerns around inputs, technology transfer, etc., that Mr. Mohanty is highlighting, does this look like an achievable? The intent is great, but does it look like an achievable target? Just very quickly, Mr. Mohanty, and then I'll come to Mr. Mahadevan.
Yeah, can I come in?
Yes, please.
Actually, technology particularly, there are so many countries are there, like Japan is one, then the South Korea is there. But the technology is heavily guarded. They are just the wait and watch thing is going on. The discussions are on. Like Intel's Mr. Madhavan will throw light on this because they are making this powder magnet. So in the powder form, they are making it. So if they will tie up with these technological providers or like Ashwini Magnets or this Midwest, they will make up to the level of metals. So if they will tie up with these companies of India for making up the metals, and from metals to making up the alloys and
so let's ask him. Let's ask Mr. Mahadevan. Mr. Mahadevan, sir, ambitious program. Is the money that's been put up, the capital outlay, is that enough? And then the program says that over the next 5 years, we should be able to produce 6,000 tons of these rare earth magnets, starting from the oxide level all the way, up to the final product. Does it look feasible?
It does. It's not 5 years, if I can correct you. It is 2 years of gestation plus 5 years, which goes into production. So the span is 7 years.
Okay.
Right. And 2 years is adequate time for people to convert the oxide, which is the upstream delivery level, down to the midstream product, which is exclusively technology, know-how, HR intensive. We are very confident that this would happen in the country, and there's a lot of forums and a lot of academic as well as research institutes are working on it, and also the government in different forms like Technology Development Fund and Technology Development Board, as well as NCMM, which is National Critical Mineral Mission. They're all supporting this to happen. So in the 2 years' time, I'm very, very confident that the gestation would be over. In fact, Etalis is confident that we will be in about a year's time, getting into the sintered REPM's time to take advantage in the second year. The policy is not completely out yet. There are a lot of things, details, finer details that one has to look into to answer it in terms of what kind of tie-ups. Tie-ups are extremely important with Indian or overseas entities is very important as part of the game. And this incentive is given at the push, and we've been in the industry now for 3 years, and prior to that, I've worked particularly on this particular industry for more than 4 years, along with my colleagues. People who are not willing to listen to India, subsequent to the incentive being declared, are very open and very willing.
All right, gentlemen, we'll have to leave it at that. Unfortunately, the audio is a little scratchier than what we'd imagined for it to be, Mr. Mahadevan. But Mr. Monty, Mr. Mahadevan, I'm sure this is a conversation that, calls for a bigger discussion, and it will continue. It's not something that stops with the calendar changes. So we will promise to have this discussion once again and take on a better line, and, at a time when we'll have a little more data to, ask you on the real situation on the ground at that point as well. Mr. Monty and Mr. Mahadevan, wish you both a very happy 2026. Take a short break, come back, focus on the markets. There was an intermittent recovery where the Nifty moved into the green, but thereafter it's, holding on to that by giving up a little bit. The Nifty is down about 11 points, a significant recovery from the lows, but still off the highs. Stay with us. Right, the Nifty is back in the green. It's a 142-point recovery from the low on the mid-cap index. The Nifty Bank briefly in the green as well. And the Nifty's up move, actually, apart from the Nifty Bank, has been led by a lot of these auto names. So pull up something like a Hero MotoCorp. That's moved to the high point of trade. We're seeing some traction in M&M, Bajaj Auto, all of them as well as we move towards the end of the month, and more importantly, the start of the new year, where we will see some sort of sales come by. The street is looking at 2026 because December seasonally is the weakest month for auto sales. Banks, we have Axis Bank, which has seen an up move, and that's leading the recovery on the Nifty Bank. And we've also seen some purchase on Hindalco, which has again moved to the higher end of today's trading range so far. Hindustan Copper is the other one, which continues to surge up around 6%, notwithstanding the decline that we saw in commodity prices overnight. Good time to welcome Chandan Taparia of Motilal Oswal Financial Services, who joins us now. Chandan, we're finding support at lower levels. We're finding supply at higher levels. The only difference is that the range continues to get narrower. Where are we going from here on the frontline indices, and what individual stocks do you like?
Yeah, good morning, Mangalam. Thanks for having me. So Nifty has got stuck in between 25,700 to 26,300 from last almost 10 to 15 weeks. But the good part is that declines are being bought even after the absence of follow buying interest. If I look at the lower time frame, Nifty is negated or set to negate its lower top, lower bottom of last 4 days. It is taking support near its 50-day exponential moving average. So believe that some support-based buying could be there. So as of now, 25,800 is major support, which can provide us buy on decline stance for a recovery towards 26,100 to 26,150. So one can go with buy on decline with positive to range bound bias, but overall trend remain intact with a broader range. And as per the seasonality, we believe some more consolidation could be there in the market going forward. Talking about Bank Nifty index, it has been moving in between 58,700 to 59,500 from last 22 trading session. And now we are exactly at the lower band of the trading range. So we might see a negation of lower top, lower bottom after the profit booking decline of last 3 days. So with support of 58,700, we can see a bounce towards 59,500 kind of level. So in both the indices, buy on decline could be seen as we are trading at the lower band of the trading range.
You know, I was talking about Hindustan Copper in the morning, and I think it should come up on your screen. Last I checked was up about 5-6%. Any thought? I mean, this is of course after the 50% move. It's already seen in December. Any thoughts on this one? Hindustan Copper?
Yeah, Prasant, we are quite positive on most of the metal name. In fact, as per the seasonality, usually December month remains quite good for the most of these counter. And Hindustan Zinc, Hindustan Copper, Vedanta, National Aluminum are preferred counter. And Copper we have recommended many times. Even still at current zone, when stock rallied by more than 25-30%, we have the same conviction. And I believe that till it holds above 495, the ongoing momentum can extend towards 555 to 575. So I think bullish stance could continue and one can hold the position with trailing support.
What are your own trades?
Yeah, so talking about preferred trading ideas, first trade is buy on Mahindra and Mahindra. It seems that now Nifty auto index is at words of consolidation breakout. Mahindra and Mahindra has negated its lower top, lower bottom of last 20 trading session. We are witnessing some put writing and rollover seems to be better. Higher base is clearly built here, which is an early sign of the momentum to kick on. So one can buy with support of 35.70 for an upside target towards 37.50. Second trading area, there is buy on AU Bank. Major trend of the counter is positive. It has been making high top, high bottom on the weekly chart. And now it seems for a fresh breakout after the consolidation of last 12 days. Rollovers are betting better and we are expecting some short covering trigger in the counter led by coal unwinding. So one can buy with support of 970 for an upside target towards 1030. Last trading idea, there is buy on National Aluminum, positive on most of the metal counter. This is one of the strongest counter. Roll cost is positive with built up of long. Put writing is visible. In fact, we have seen surge in put call ratio. So recommending to buy on Nelco with support of 296. It can head towards 320, 323.
Thanks very much for that. Always good speaking with you. And Chandan, thank you for taking us through those specific trades as well. Season's greetings to you and your team and family. Well, what we're going to do is take a quick commercial break here. Manisha is going to join us with, of course, an eye on cryptocurrencies and how they've done in 2025, maybe some forecasts for 26 as well. Stay tuned, coming up. Well, welcome back. Let's shift focus to commodities, and you know, you can't really call it a commodity, but maybe you can. It's been called the new gold, but I guess old gold is the new gold. Has been all through 2025. I'm talking about cryptos, right? Manisha is now standing by with what happened with crypto. Of course, when Bitcoin and other cryptocurrencies. I mean, performance in 2025. Manisha really lagged behind. I mean, the real gold and precious metals, didn't it?
It did, yes. And, you know, Prashant, you have to look at crypto in sense of two halves of this year. There was the first half for crypto, which was very bullish. You had various trendy regulations coming in. Prices were hitting all-time highs. But the second half really turned all of that around. But that happens with crypto. Every 4 years, you do see some profit taking coming in. And this is pretty cyclical, the way you look at that. So I am also going to talk about crypto in two ways, the positives and then not so positives. When you come about positives here, well, crypto did enter mainstream as we did see it. You saw crypto being added into strategic reserves by various countries. Russia, US are a few to count with. And then you saw corporate treasury allocations come in as well. But in the first half of this year, I was talking to various US companies and they said, you're seen as not progressive enough if you don't have crypto on your balance sheet. So that is what the narrative was going around as well. And then we did see cross-border settlements as well when it came to crypto in this year. So it did come mainstream in various ways there. When you also look at the real-world asset tokenization, that also started to happen. institutions started to come into the crypto as well as in sense of investors. So it wasn't just the nerds or the enthusiasts or even retail for that matter, but corporates, institutions and governments started talking about crypto. The regulatory policies that we saw come in from various governments also were more on the positive side, whether it was about Korea or Singapore, Russia, Ukraine, various European companies, and then, of course, to top it all, it was US, which continued to talk very, very positive about the crypto markets therein. It also is about the real-world application. So cryptozation or tokenization, real-world asset allocations is what we saw happen in this year on a very, very strong note when it comes to crypto. Add to that the fact that the spot ETFs did very, very well. Well, Bitcoin ETF was first launched in Jan 2024. It has been the most successful last year, and the momentum continued to build in this year as well. With $160 billion of a holding therein and trade, it clearly has been one of the top ones there. The market cap hit a record $4.3 trillion in this year, but that was all about the first half of this year. We also did see US introducing the Genius Act, and the markets are still waiting for a Clarity Act that was supposed to be cleared in the month of December. Doesn't seem to be happening right now, so we will perhaps see it in the first quarter of 2026. Apart from that, as the Genius Act came in, it was the stable coins. While we did see all-time highs for Bitcoin, but stable coins clearly took the cake away with capitalization at around $310 billion. Stable coin is something that almost all countries were talking about. And then if you look at the overall capitalization, that it ran up. The Bitcoin prices hit an all-time high in the month of October at 1,26,000. They're trading at around 87 to 90,000 at this point in time. And that's exactly where the not-so-positives come in, because we did see a very heavy profit-taking come in for Bitcoin there. It has declined nearly 35% from its all-time high in this year. The US Federal Reserve adopted hawkish stance, and that changed on how various asset classes were trading. You saw decline in equities in various countries. There also was money flowing into tangible commodities like gold and silver, and some money that came out of crypto perhaps also went there. A lot of ways that met with crypto were in sense of AI, and we saw money going in there in sense of electrification and in sense of investments as well. And then apart from that, it also has been about markets looking at losing $1 trillion in sense of market cap there. So from 4.3 of a high, we are trading at $3 trillion of a market cap right now. And then it was about US tariffs on China, the rest of the world. That also led to liquidation across asset classes, and crypto perhaps was majorly hit. Now, when you look at the prices therein on how the performance has been for 2025, if I was talking in the month of June, this was all double-digit percentage on the higher side. But right now, we are trading in the negative for most of them. You have Bitcoin, which is down 6.5%. Ether is down 12%. Both of these cryptos have seen all-time highs in this year. Binance is the only one trading in the positive. But look at Cardano, down 58%. The others which hold high in sense of market capitalization, like a Solana, Ripple, are down 11%, and 60 to 70% of a decline is how we are closing 2025 in sense of Polkadot and Avalanche as well. Okay, so the money moved back to the OG asset class, I guess. Gold and silver, it was. Cryptos, maybe for another year. We'll see if 2026 will be that year or not. But Manisha, thank you so much for the roundup. With that, we wind down this edition of Bazaar. Thank you for watching. Stay tuned. Chartbusters coming up next.